Welcome to the Protect Your Assets Market Briefing. I'm David Hollander, your host. Now let's get started. U.S. stocks posted their strongest week since April. The jobs report, which was not the greatest, had the market feel like the Fed will not be raising rates, and markets took off. The softer data really helped. The Dow Jones closed at about 54,000 for the week. It was up 2.9%. Year to date, the Dow's up 12.3%. S&P, however, closed all-time high 77.48 for the week, saw up 3.4%. Year to date, up 13.2%. The NASDAQ, well, that was up 5% for the week. Year to date, up 14.7%. The international index, once again, the MSCI EAFE index, up 2% for the week to close at 16%. And the index now that was up the most this week, from what I track, was the Russell 2000, up 2.6% for the week. Year to date, Russell 2000, those small cap stocks, up 21.5%. Wow. But that still is not the best. The best overall was oil. Oil was up once again this week about 5%. Year to date, oil's up 40%. So you can see the trajectory there from 12 all the way to 40. The 10-year treasury is down this week, closing at 4.61%. So all of that helped. What happened this last week? Why in the summer, when things are usually quiet, did the market get super excited and have such a great week? And this just shows you, I mean, I always say this, but you cannot try and time the market. More about that in a second. But this past week, there were really three major headwinds that we've been talking about that all of a sudden just eased up. And this provided a backdrop for stocks to go higher. Those were improving confidence in the AI demand. We've been talking a lot about AI and what it means to the market. So that shifted this week. We had, even though oil is up, still lower overall. Remember, oil got over 100 back then. Now it's not even close to that. And of course, there were reduced fears about the Fed raising interest rates. That was a serious concern that seems to have backed off. So again, what's happening? Well, earnings continue to support the stock market. The second quarter earnings are rolling out and they're tracking near 29%, even after adjusting for investment related gains. We saw Google and Amazon this past week had good numbers. Importantly, earnings is broadening beyond just the mega caps with all those different indexes I just talked about. That's the broadening of the bull, if you will, spreading across the strong equity market. Economic resilience, it's intact. Manufacturing activity, well, that went to a 4-year high. Again, that's just us producing stuff. And July's oil price spike didn't really seem to affect that. We saw slower wage growth and also this cool labor market that I've been talking about. And what that means ultimately is that inflation seems to be under control right now. So we're seeing the market moves right now to new highs. This is confirmed by these strong earnings that we keep seeing. And the earnings growth is broadening really beyond the mega cap tech sector that we keep hearing about. But of course, we always got to keep in mind the technical data. This is different than the fundamental data. And I try and educate folks about this because there is a difference. You have people who track technical things to justify market valuations. And right now, there is a difference in risk compensation when you look at the size, style, and industries. And now traditional value, remember value is a sector of stocks that we look at as compared to growth or balanced. And the traditional value and quality focused indexes seem to offer a little more appealing equity, what we call equity risk premium, than those that have concentrated growth. So remember, growth's the other side of value. AI sensitive holdings. So plainly said, what am I talking about? The Dow averages still pay you to take equity risk, while the NASDAQ and the high flying semiconductor index like the SOX, the SOX, pay virtually nothing if you're looking at that sort of a risk premium, as we call it. And the large cap quality value focused averages and profitable small caps are still paying investors to take that equity risk. And the tech heavy, which again, technology and AI, which had a very strong week, once again, these growth focused names from small cap to mega cap names are over their skis a little bit right now. That's what we would call it. So that begs the question. This came from Scott this week. Scott asked me a great question. Is buying the market right now at an all-time high, is that really a good idea? So Scott, great question. And over the past 3 months, markets have successfully absorbed several key headwinds that we've been talking about. Remember, we talked about Iran, of course, and the Fed, and Iran related to oil, of course, and of course the economy remaining resilient in earnings, and all these things we've been talking about the last 3 months. And with the market being where it is right now, it seems like it has absorbed all of that data and information and still is pushing higher. So rather than triggering a correction that lasted and got deeper, those concerns really led to a rotation out of some of these stocks that we're talking about into things like financials, healthcare, energy. Those started to assume leadership, and that's why you're seeing all of these indexes spread that positive return across the different sectors we were just talking about. Most recently, this past week, of course, tech had a very good turnaround, and that's the nature of tech. It's very volatile. It's up, it's down, and that can happen relatively quickly, and you can't time that. You either in it or you're not. But if those stocks are heavily laden in your 401k, then this is a great conversation to start talking about, well, what should you do now when markets are at all-time highs and some of this leadership could start to shift. Now, what I will say about this is that when a market reaches an all-time high, and you look at history, like Scott, you're wondering whether it's a good idea to put money to work. And while pullbacks can occur at any time, like we've seen this year, this has been a pretty volatile year. Go ahead and look at the monthly returns on your statement. History suggests that new highs have not typically been poor entry points to get in the market. What do I mean by that? Average forward 3-month returns have been slightly lower when you invest at an all-time high, but the gap starts to disappear when you start to look at the markets over 6 months, 1 year, 3 year, and 5 year horizons. Average returns have actually been higher following all-time highs rather than investing on a typical trading day. So in my view, the lesson is that new highs often occur because fundamentals are improving, not because a market advance is ending. And so as a result of that, time in the market has historically mattered more than waiting for that perfect entry point. So a lot of you sitting in cash right now have been trying to time that market, waiting for the correction where you're going to, quote, pile it all back in. Not necessarily a good move. And the bottom line is we believe that the durability of the earnings that we're seeing right now, this remains the key pillar which is supporting the markets. Now, there is great argument that a lot of this AI earnings that are reported is not sustainable. It's just overblown. Well, again, that's just part of the market. It's not the full extent of the market. And so I wouldn't disagree with you on some of those names. We're not talking about thousands and thousands of different stocks that have nothing to do with that. The economy continues to demonstrate resilience. And like I said, the manufacturing activity that came out this past week was big. And because of that, we are seeing the market start to take leadership in these other areas that we've been discussing the last few months. So in this kind of environment, we believe investors should avoid becoming overly concentrated in any one single theme. And so for those of you getting ready to retire, maybe you have a big concentration in a particular stock. I'm still seeing a lot of that as you're coming in and talking to us about what you should do as you prepare for retirement. You want to keep in mind that your risk tolerance and your income needs in retirement are something you need to start to consider right now if you're getting ready to retire. And so you might want to reposition or readjust some of those things to align with what you're trying to do. So what are we watching next week? The July Consumer Price Index, that's the inflation, true inflation number. That'll come out Wednesday. And the central market we're looking for is whether the inflation number is around 3.4% year over year. That's healthy. That's a good number. If it comes in higher than that, that could be a problem. We will see the PPI, the Producer Price Index, get another sign of inflation on Friday. I'm sorry, that's Thursday. And then retail sales will come out Friday along with consumer sentiment, which is important because if consumers aren't spending or feeling good about it, then we've got a problem.
You can hear the Protect Your Assets Market Briefing on your favorite podcast app. Just search for Protect Your Assets Market Briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA Market, libertygroupllc.com/PYA Briefing, libertygroupllc.com/PYA Market Brief. Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.